hedge strategy. Are you looking to hedge only items which are on your balance sheet and not really those which are going to happen in the future? Are you looking for economic hedging of risk of, let's say, those items which are not yet in your books? So those are all the considerations that you have to keep in mind while you decide on the applicability of hedge accounting to your specific case. Okay. To summarize, if you can understand, rather, if you can keep this set of scenarios where hedge accounting is useful in mind, you can evaluate based on your own perception and hedging strategy, whether hedge accounting is for you or not. Long-term forwards, long-term currency swaps, long-term options, and IRS trades, obviously, interest rate swap trades, and payable, receivable of highly probable exposures, meaning those exposures which are not on your book. In these cases, hedge accounting is useful. In other cases, you don't see much value of doing hedge accounting. For example, you already have a payable on your books. You import regularly, and your strategy is to hedge only those which are invoiced exposures, right? Meaning you already have an accounts payable in your books, forex payable. Only those you have to hedge. The cash flows of that payable is what you're hedging for a short term. In such a case, hedge accounting actually has not really much value. Why? Because hedge accounting the fluctuation of mark to market of the hedge in a short time frame is not significant. 6 month forward or a 5 month, 3 month forward, the mark to market change of the forward due to the forward premium is not as high as, let's say, a 5-year forward will have. So the benefit of doing this hedge accounting is not significant in terms of the smoothing out of the quarterly volatility. And secondly, the process is intensive. If you go for a lot of short-term exposures, if you put them under hedge accounting bracket, then you are ending up with a lot of documentation. You have to document for every hedge you are doing, you have to document. And also, hedge accounting by definition is hedge accounting, meaning you're supposed to be hedging. So if you want to be a bit dynamic in your risk management, meaning you want to, that is to say that you want to cancel the forward, rebook the forward, early utilize the forward, pull over the forward, and so on, then this is not something which you can, like you do any other thing. It requires tremendous documentation. Right? So to summarize, you have to therefore focus on your own risk and benefit analysis and then decide on the hedge. So that's what